Okay, people are hopping in. We'll give you just a minute here to get everybody in, and we'll get started in just a few minutes. Again, I see a couple more people popped in. We're just going to give it about a minute, make sure everyone can get in and join. I do have everybody on mute. There will be some opportunity for Q&A in the chat, so just hold tight on that before we get started. Thanks. I think we can get this kicked off. So to start, just want to say hi, everyone, and thank you for joining us today for today's market update. I'm excited to welcome two outstanding speakers that we have today here from Kensington Asset Management. They're going to be sharing timely insights and perspectives on our current market environment. First, we've got Joe Dattolo. He's partner and regional director at Kensington with over 23 years of experience in financial services, a deep background in both traditional and alternative investments. And joining him today is Brian Weisenberger, CFA. He is the managing director and chief market strategist with Kensington Asset Management. He works directly with their portfolio management teams to help shape the firm's market outlook and has over 2 decades of experience spanning portfolio management, research, due diligence, and also a member of Kensington's executive committee. So we'll hear from both of them today. As I had mentioned, as a few of you were joining, we will have some time for Q&A. You should have the ability to enter those into the chat. If anything comes up as we're going through kind of the front end of the call, please type those in and we'll make sure that we get to those at the end. And to kick things off, I'm going to pass this over to Joe to kind of give us a state of the union of, hey, it's July 1st. We made it through the first 6 months of the year. What's happened so far in 2025?
Sure, and thank you, Elizabeth, and thank you everybody for joining. I think this time last year, Brian and I were actually in person up in Buffalo. Sorry we're not there in person, but I think this is going to be full of value and great insight from Brian. It's always pretty special to have Brian with us, as Brian is our chief market strategist. And want to say thanks to Elizabeth, Jeff, Brett. The partnership's great, and thanks to you all. I think most of you on this call and on the Zoom have exposure to us primarily in our dynamic growth, and so we'll talk a little bit about that. And I would tell you, it's really been, if we look at the last 6 months, we can divide it in half, and I think we've all felt it, right? In the first 3 months, it was pretty extreme volatility. I think there were a couple of factors to that volatility, and we'll talk, in January, and this is all pre-tariff, right? We had, I think for the first time, real uncertainty around the Fed. I can tell you in years past, right, we've always had some idea of, at the very least, the direction of a Fed, either, rate cut or rate increase. We were really certain on the direction in which the Fed would go. Really, the questions we would ask is how much, right? How much will the cut be, or how much will the raise be? In the beginning of this year, I think for the very first time, we had zero certainty on the direction of the Fed, right? And to be able to miss on, and I'm sure Brian will talk about this, on the size of a cut or increase is one thing, but to miss entirely on the direction in which the Fed will go is another. And so I think that was the primary cause of concern, right? We had large financial asset managers such as Apollo assigning a 40% probability of a rate increase earlier in the year. On top of that, inflation, right? Inflation is here. I think potentially it's probably here to stay, although we started seeing headlines this week of increasing inflations. Hopefully it's all contained. We had a very expensive stock market. We continue to have a very inexpensive stock market. So you take those factors alone, and that led to a lot of volatility, and then comes the tariffs, right? And so Trump comes on board, whether we agree or don't agree with the tariffs, certainly there was a lot of emotion and a lot of reaction. And I would tell you, I think primarily in the last 3 months of the year, right? So from April to June, I would say markets have just become a lot less emotional and a lot less reactive, right? Iran and Israel is a great example of that. So we are chugging along, and Brian, this is, I'll kind of lead into you with this. We have some pretty large macro data points coming our way. And I'd love to understand your thoughts and the team's thoughts on, is this good? Because we've gotten very comfortable over the last couple of weeks, right? It's volatility has been very, very low. And I'm proud, and I'm sure you guys potentially have noticed, we at Kensington, we certainly perform well and admirably in a normalized market, normal and low volatility. But we've been able to handle the first part of this year incredibly well. The dynamic growth, which you guys all hold, right? We're currently about 18% ahead of the benchmark, which is the S&P. And again, the hallmark of the firm is defense, that ability to sidestep that volatility. So far, we've done that really well. Brian, my question to you would be, do we think defense is our value add in the second half of the year as it was in the first half?
Yeah, it's a great question. Joe, I think you really hit it on the head in terms of what we've seen in the first half of this year. And I think likely what we're going to see in the second half. And if I could just put some statistics around this for those that maybe don't follow it on a day-to-day basis, we had a 23% drop in the S&P 500 from February highs until the April lows on April 8th. We have since then had the fastest recovery of a 15% correction in S&P 500 history. So a rally of 24% to hit a new all-time high yesterday and Friday, the day previously. So a miraculous recovery. And to Joe's point, a really changing landscape. We've also had the largest decline in volatility in a 12-week period, with the VIX, which is that fear index, going from a high of 45 to 16 just 4 days ago. So a lot of changing realities of the market as we go. And I think while we have certainly hit a subdued period today, I don't think that's likely to be the case going forward. And if you just look at the first half of this year, we had 21 days of 1% declines in the S&P 500. We also had 20 days of 1% gains in the S&P 500 in the first half of the year. So volatility cuts both ways. It can be detrimental. It can also be beneficial. And I think as we sit here today, we're still in an environment where there's a significant amount of trade uncertainty, and uncertainty typically leads to volatility. And so while we're getting some clarity from a tariff perspective, I think policy is likely to remain fluid. And I think that that's going to lead to more volatile environments going forward, which certainly from a tactical perspective, we think we can take advantage of. But I think it will continue to be the definition, despite maybe a little bit more of a relaxed environment over the last several weeks. I think we're not far enough removed from what we experienced in the first half of this year. The S&P 500 ended up 573 or so in the first half of the year. You'd think that that was a pretty boring year, but certainly to Joe's point, went through many seasons in the first half of the year. And I think that that's likely to continue. The other thing that
go ahead, Brian.
Sorry, just the other thing that I was going to point out as it relates to what we saw in the first half of the year, because I think it's important for the next part of this conversation, Jeff, which I know we're going to get into. But if you look at that recovery that we saw in the period from early April until the end of June, one of the things that seems to continue to pop its head up over the last several years is that recovery was led by, stop me if you've heard this before, technology. The technology sector was up 41% since the lows in April. It's the best quarterly gain, the second quarter that technology's had since the second quarter of 2020. And so while it's nice that we have that leadership, and certainly if you have a small number of companies that are going to lead, it's helpful if they're the largest companies, but it also creates a significant amount of concentration in the market. Despite hitting new all-time highs over the last several days, only 5% of stocks in the S&P 500 can say that they've also hit a new all-time high. And the top 10 stocks in the S&P 500 make up 38% of the market cap and 30% of the earnings. So that's,
Can you
again,
say
not
that one
inherently
more?
bad.
Can you go back to that, Brian? Because I think that's a really important concept. Can you repeat that statistic of where we
Yeah,
stand today on that?
absolutely. And I'll put a little context around it. So if you look at the S&P 500, which, as you would guess, has 500 companies in it, the top 10 largest companies in it, so the top 5% of companies in it, make up 38% of the index. They make up 30% of the earnings of that index. And so they are extremely important in terms of the direction of the market, if we're going to say the S&P 500 is the market, because they're going to have an outsized influence over the directionality of the index going forward. And that's been the case for 2 years.
And for the people on this call who might not be familiar with that, what are those 5 companies currently?
Yeah, so 10 companies, but you can think about it as, the Magnificent Seven, which we hear about all of the time, right? So that's going to be Amazon and Alphabet, which is Google, and Microsoft and Meta and Tesla and Nvidia, and I always forget one. But it's those technology-led companies that also happen to be the largest companies, not just in our country, but in the world. And so we are in a technology renaissance, certainly with the AI revolution that we're experiencing, and those companies are the ones that are leading that charge. And as a result, they're also the ones that are leading the market.
So if I'm hearing you correctly, right, chapter 1 of this year, volatility and the biggest tech leading the way. And it looks like chapter 2 is going to be more of the same. So, more of the same, but nothing is always the same. So is there anything that you're seeing that's going to be similar, but maybe different in the second half of the year? Are there any obstacles that you guys are seeing that you think maybe will present themselves in the second half of the year that didn't in the first half of the year?
Yeah, well, I think that it's more of an extension. And one thing that I'm really focused on, and again, Joe mentioned this on the onset, is how expensive the stock market is. So if you measure the expensiveness of the stock market, and the most common way to do that is by looking at what's called a PE ratio, is just looking at what is the price of a stock or an index relative to the earnings of that stock or index. And that'll tell you how expensive or cheap a stock is or a market is. And if we look at the market today, the S&P 500 is trading at about 22 times earnings, which is higher than its 5-year average. It's higher than its 10-year average. It's about in the 99th percentile in terms of historical valuations. And what does that mean? Well, typically what that means is that returns going forward are likely to be muted as that ratio normalizes. But it's important to note that when people talk about the forward returns, when we have high or low valuations, they're usually talking about a 5-year period. The high valuations can remain high for a significant amount of time. You saw it in 2024. You saw it in 2022. Both of those years had the S&P 500 up about 25%, despite persistent high valuation. So what the determining factor is going to be in the second half of this year is going to be earnings of those companies, because there's only 2 variables to that equation: price and earnings. And if price is high, then in order to support that and to see the stock market go forward, earnings are also going to have to be high. And that's what we have seen over the last 6 quarters. We've had at least 7% earnings growth over the last 6 quarters. The last 2 have been double-digit earnings growth, and that has supported a high valuation. And so one of the things that's going to determine our ability to move the stock market forward is, can earnings keep up? We initially saw analysts revise all their earnings expectations for Q2 down on fear of tariffs cutting into profit margins, and that's kind of dissipating now. You're starting to see a lot less concern about that. It hasn't shown up in the data yet, and so earnings estimates are now reverting back up. In fact, we've hit a record high for earnings expectations 4 weeks in a row as we enter into earnings season right now. If we can hit those earnings expectations, then there's room for the market to continue to grow. But a concentrated market, an expensive market, does lend itself to a volatile situation, because if any of those large companies miss earnings, then it can have an outsized impact on the short-term expectation for the market. So that's one thing that I'm certainly looking at.
So I think that's a perfect transition to what I wanted to ask you next. So lots of volatility in the market. I want to take a moment and connect this back to how we approach things at Nova Wealth, especially for our clients that are approaching retirement. So, as Joe and Brian and obviously, Elizabeth and our clients on this call know, we use a bucket-based strategy. So we're dividing assets by time horizon for different purposes. So our clients can have predictable, sustainable income in the short term while still participating in market growth over a long period of time. So to maintain the growth-oriented buckets, like we're leaning on tactical managers. So obviously you being one of them. So, we're actively, you guys are actively adjusting the portfolio. So when Elizabeth and Brett and I, when we're talking to somebody or doing a webinar at 12:16 p.m. and we don't know what's going on in the market, you're kind of doing that in the background. So, leaning on you during market conditions of, with extreme volatility rather than just simply riding it out. So in simpler terms, instead of just, hey, we're just going to buy and hold, we're going to be more of active management. So can you kind of explain a little deeper of what tactical management really means and how Kensington applies that philosophy across your portfolios?
Yeah, absolutely. And it's an interesting question because tactical is a term that's used broadly, and it can mean a lot of different things. Generally speaking, tactical management means that you're trying to assess the market environment using some input. It can be macro inputs, GDP and inflation. It can be price information. It can be any source of information that you're trying to evaluate. What are the prospects of the stock market or the fixed income market over the next period of time? And based on that assessment, then it's a matter of shifting your portfolio exposures to try to take advantage of the expected market or to avoid the expected market. If you think that we're headed for challenges, then as a tactical manager, you'll shift your portfolio defensively. If you think things are going to be good, then you'll shift your portfolio more aggressively. And the general premise is, at least from our perspective, is if you expect that there's going to be heightened level of risk going forward, then it doesn't make sense to just idly sit by and take what the market gives you. It's not always about being right or wrong, but rather positioning your portfolio to the probabilities of what you expect is going to occur. That's generally what tactical management is going to mean. Now, for us, we're pretty high conviction tactical management. So in our fixed income fund, managed income, and in our equity fund, which is dynamic allocation, we're operating in a risk on and risk off basis. So we're assessing the market, and then we're either going to be 100% invested in our target market, or we're going to move to the sideline and we're going to get defensive. We're going to be in cash. We're going to be in treasuries. This year's a really good example on the equity side. We had moved defensively for much of that first part of the year when volatility started to spike up. As a result, we were able to avoid the drawdown that we saw on Liberation Day, but we were tactical enough to then also identify an opportunity after that sell-off, get back into the market and take advantage of the rally that came after that. So we're an all in, all out, and we're assessing the risk or opportunity in the market by looking at a few different things. The number one thing for us is volatility. When volatility is elevated, we think that means heightened risk. And when volatility is lower, we think that means lesser risk. Now, that's not all that goes into our equation, but it's a starting place for our assessment. If things are moving fast, if volatility is high, we're going to be more conservative and vice versa. And so that's how we're approaching the tactical space.
If I can ask a follow-up, Brian, sometimes we take on clients who maybe have been tactical, or as I like to say, their buddy Joe at the water cooler thinks he's tactical, right? They've kind of tried to play the stock market on their own, and a lot of it is emotion based, right? Is I'm worried about X, so I'm going to go to cash, and I feel really good about the president or whatever's going on, so I'm going to be 100% equities. I think it's really important that we can maybe explain a little bit more about how like how do those changes happen with Kensington, you know, and specifically your portfolio management, and that it's not an emotional reaction, and how long, like what that process looks like, how long you've been working with that process. If you could expand on that a little bit.
Absolutely. I appreciate you bringing it up because it's a critical part of how we assess the market. So we do believe that there is real value in taking the emotion out of the trading and management decisions. And so everything that we do is model driven. So we've designed a system to assess the market and indicate when it makes sense to take risk and when it does not. Everything that we're doing is predicated on that modeling system that we've developed, which has been in development and had been in use in some form or fashion since 1984. We started using a model-based system to assess market risk and opportunity in the 80s, expanded upon it. We launched our first strategy in 1992. That was in the fixed income area, launched our first equity strategy in 2015. And so we've had an opportunity to really look at a lot of different types of market environments to determine what are the best inputs to look at to determine what the opportunity set is going forward in a completely unemotional basis. You know, the truth is, if we were following my discretion, we would be wrong a lot more. But taking that emotion out of it has been really effective for us, and it also can be a really good complement maybe to more traditional managers that are using some emotional inputs that looks at it. And for us, we're looking entirely at price. So we think that price ultimately drives the market. And so we're going to assess, is the price of whatever our target market is, in this case that we're talking about, the equity market, trending in a positive direction or trending in a negative direction? And how does that interface with our assessment of volatility? And that combination allows us to be nimble. But the other thing I would point out is that you sometimes hear tactical and you think high frequency trading, like there's a black box and things are just trading in and out of the market 15 times to 100 times a day. That's not what we're trying to do. We're really trying to identify the longer term risks and opportunities. If you look at our equity strategy, it's typically going to trade 5 or 6 times a year. So less than once a month. We're typically measuring our trades in months and weeks, not days and hours. So it's really for us about trying to, again, through a purely emotionless process, identify the big risks, the big opportunities, and then either participate in those or move to the sideline. We're happy to take some volatility in the market. What we really want to do is avoid the meaningful drawdowns, the COVID crash type drawdowns, the Liberation Day type drawdowns. Those are portfolio killers. And if we can avoid a meaningful number of those and participate in a meaningful number of the market rallies, then we think it's a really good formula for success over the long term.
And, you know, I'll just add a little bit more on how that fits really well with our, you know, bucket-based approach is kind of controlling that maximum drawdown. And going back to what you said about, you know, some of the bigger drawdowns, right? Like COVID, right? You know, it's like, hey, we don't want to see when you're taking income, your portfolio drop 35% in a week. And we understand that with Kensington and other tactical managers, it's not like a magic formula. You're not going to never lose money or anything like that. But if you can avoid the catastrophic loss and still participate in the up market, it gives our clients a better chance to achieve their goals throughout retirement. So we definitely appreciate all the work and all the research that you are doing on the back end as we're on the front line with the clients. And just I want to make sure for the clients that are on here, I don't see any questions that have come in. So if you do have any questions for anybody on the team here, Brian, Joe, please make sure you type those in. I assure you, any question is a good question. I don't want you sitting over lunch saying, geez, I should have asked this. So if you do, please go ahead and type that in here.
While we're waiting for those, Brian, if you could, we talked about some of the scary stuff out there, you know, tariffs and, you know, PE ratios being high, things like that. Are there any like positives, like looking ahead, right, the next 6 months to a year? Are there any opportunities that you see out there for, you know, kind of these smooth waters to maybe continue longer?
Yeah, absolutely. I think there's a couple of things. And by the way, a lot of those scary things are also opportunities. And so no coin is one-sided. And I think you can look at all of them that way. A really good example of that would be policy uncertainty. If you look back historically to periods in which we had trade policy uncertainty, and going back to 2001, there's about 10 examples, maybe not quite as extreme as this, where we had some level of uncertainty as it relates to our economic or trade policy. And what you find is that over the course of those 10 past examples, almost all of them had a positive forward 12-month return following that. Because as trade uncertainty starts to dissipate, as we start to get more comfortable, as Joe mentioned, as people start to maybe even get a little numb to the day-to-day hysterics and headlines that relate to it, the market tends to recover really well. In fact, the 12-month forward-looking return over the last 10 times has been about 22%, and only two examples of a negative forward return. So I actually think that having some uncertainty in the market and the expectation for some resolution to that can be a really big catalyst for future growth. The other thing, and Joe mentioned this as well, that we need to continue to focus on is the Federal Reserve. I mean, ultimately, that's going to drive a lot of our economy one way or the other. And while Joe mentioned that heading into this year, there was very little certainty as to which direction the Federal Reserve was going to go, I think that's starting to really come into picture. The market's pricing in about 2.5 cuts this year, likely 2.5 cuts next year. I think we have a directional sense of where the Fed is going to go because the data is starting to back up what I think everyone expected, or a lot of people expected at the beginning of the year. You have to remember the Federal Reserve has a dual mandate. They're only concerned about inflation and employment. And so those are counteracting balances. One, in order to fight inflation, you raise rates. And in order to fight employment, you lower rates. And so if those are out of sync, that it can create some chaos. But right now we've got relatively, one, calm economic markets, and two, directionally likely heading in a direction where we're going to see the Federal Reserve cut rates. If you look at GDP, which is a measure obviously of growth, it just came in negative for the first time in 7 quarters, but just slightly negative. If you look at employment, it's been holding pretty consistently as far as an unemployment rate at about 4.2%, but you're seeing continuing claims of unemployment increase. Now that sounds like a negative, but if your goal is for the Federal Reserve to cut interest rates, that's a good sign because it would be a catalyst. If the Federal Reserve is looking for a reason to cut rates, and clearly they've been holding tight, waiting to be data dependent, rising unemployment would be a really good catalyst for cutting of rates. The flip side of that is that you have to make sure that inflation's not rising. And while there's some signs that it's here to stay, as Joe mentioned, there's other signs that show a lot of consistency in where it is. And in fact, even maybe the possibility of it to go down, particularly if housing continues to weaken. So some of these economic factors don't sound like great things, but they can be a catalyst for Federal Reserve action. And when the Fed lowers rates, that makes borrowing costs lower for companies. It makes mortgage rates lower. It can be a catalyst for growth. And so that's another thing that I think can be a strong catalyst for us moving forward into the second half of the year.
All right. I don't see any questions, but certainly if anybody has any who is on the call after we hang up, feel free to shoot those our way. We've got a good direct line here to Joe and Brian if needed at any point, which is fantastic. Joe or Brian, anything else that you wanted to add before we wrap up?
Nothing from me. Joe, anything you'd like to finish off with?
No, I think I'm good. Again, thank you for the partnership, and Jeff and Elizabeth do have a direct line. So any questions that come through, and I hope all of you have a really wonderful 4th of July weekend.
All right. Yeah,
Well,
thank you
it
all
looks
for
like
joining
we
us.
do have one question that just came in.
Oh boy. Okay.
So
Do it.
says that in accordance in looking at the national debt, what will the effect on bonds be And, how will that all affect if, I'm assuming that they're, if we default, maybe they're getting at that. So maybe you could tackle that a little bit.
Yeah, I'd be happy to. In fact, I think it's one of the most important things for not just the bond market, but the overall economy over the long term. And it's hard to focus on that longer term time frame. But if you look at the current situation today, the US deficit's about $36 trillion. It is increasing by just under about 2 trillion a year, which is over 6% of our GDP. Interest payments exceed $1 trillion annually starting in 2026. And it doesn't appear that the current budget bill that's in front of Congress is likely to reduce that in any meaningful way. And so what does it mean going forward for bonds? Well, there's two scenarios. Jeff, you mentioned if we were to default. I'm going to put that one aside because the reality is the United States is not going to default on its debt unless it chooses to. But in reality, the US can print more money. And so it never will be forced to. The more concerning aspect or realistic aspect to look at is what does it mean for bond prices to that question and yield levels? And what it's going to mean long term is a couple of things. One is we already saw Moody's downgrade our debt from AAA to AA. It doesn't have a big impact on things. It did create a little bit disruption in the market, but it is a sign of a lowering confidence level globally in our debt. And what that means is that yields will get higher. The way that these bonds, treasury bonds, get issued is that it's through auction. And a large part of the buyers of our bonds are other countries. And that has started to lower. There's been less interest in our bonds globally. At auction, that means that the US has to offer higher yields or rates in order to make them compelling. And that extends then to our borrowing markets as consumers. That means our rates are higher. So the Fed can take action to try to lower or higher rates on the short end of what's called the yield curve. But ultimately, the market's going to dictate what those longer end borrowing rates are. And an increasing level of debt is going to over time make our interest rates higher than they would otherwise. And so it's critical that as a country, we find some resolution to balancing a budget, reducing the deficit. And certainly there's people working on that and hopefully they can be effective at it. But the most realistic expectation for our debt problem is higher borrowing costs. That cuts into profitability of companies. It makes it harder to buy a house. It slows overall economic growth. And that's really why it's such a challenge.
Yeah, so obviously a lot to unpack there. So no other questions came in as you were answering that. So again, we
I
really
actually just saw
appreciate.
one more, Jeff. Sorry.
Oh, you did.
Yeah, so it came. I don't know if they were able to put it in the chat, so I think that was maybe the issue. No worries. So a question that came in was for people that are maybe forced into early retirement. So all of a sudden, 5 to 10 years before they thought they were going to retire, they get that tap right on the shoulder that just says, we've got a computer that can do your job now, or whatever it may be, right, in this AI world. From a perspective of like a portfolio management perspective, like any insight that you have there. I know I probably have what our thoughts are here, in regards to income planning, but anything that you'd like to share with that, Brian, on like what people should be thinking about maybe that they maybe didn't have to before when it comes to having their portfolios ready, maybe sooner than needed.
Yeah, well, I think you guys probably have a better perspective on that from a portfolio management decision. The only thing that I would say is really what you guys are already doing, which is make sure that you're incorporating different types of tactical management and portfolio management styles into a portfolio, because the biggest killer to you as a client that has to rely on your savings is taking a significant drawdown. And so to the extent that you can diversify in order to avoid that, it's going to be the most important part. The other thing I would mention is if you are a retired person that relies on the income from their portfolio, looking at multiple types of sources of income. There's a lot of ways that you can generate income in a portfolio, and I wouldn't put all of my eggs in a basket of depending on the yield curve or what the Federal Reserve is going to do, because sometimes we don't know. So I'd explore different types of ways to get income into the portfolio, and more than anything, diversification, I think, is just absolutely critical.
And I think if we can answer from our perspective, just to kind of double down on what you said, it's really, you know, that like sequence of returns risk, right? If I had a sequence of returns risk slide right now, I'd show it because I feel like it's a really important thing to talk about. Is, you know, a lot of clients, when we take them on, they're kind of in that transitionary period where they look at their 401k statement and say, oh, I've done pretty good, right? I've averaged 6, or I've averaged 8, or I've averaged whatever that number may be. And we have that conversation of accumulation is much different than distribution, right? And I think that that's the most important thing, which is when we're accumulating assets, you know, if we have some of those down years, you take some of those hits, you have the time to kind of make up for it because we haven't turned the spigot on. I think, you know, to your point, Brian, where the issue becomes is once we actually start distributing that income, and then if that account, maybe you're in you know, the 60-40 portfolio, or you know, even a 1090 portfolio a couple years ago, right? It was down over double digits. You're in one of those situations, the spigot's on, and now we're having to absorb and feel those losses, you know, just to kind of do a little plug for us and how we do things differently. You know, really that bucket approach is trying to minimize those instances of catastrophic loss, especially during distribution time. So
The example I
thanks.
like to use there is the Corvette that got you to senior prom is not the car that's going to get you to soccer practice with 3 kids. So you might need to change your approach as you get a little closer and entering retirement.
Yeah, those people who are 5 to 10 years out, right, Jeff? It's like if you're at goal or you're close to goal, like what are we trying to do? Like, are we
I
trying
take
to,
undue risk.
yeah, are we trying to double your money at this point? Or are you just trying to preserve and make sure that, hey, I can do the things that I want to do when I want to do them? You know, I think for most of our clients, I think that's why they really enjoy the tactical style of management is when things are going on in the market, you know, and they call us up, our answer isn't just, yeah, wait it out, sit on your hands. It's, hey, we've got people in the driver's seat, like Kensington, like some of our other managers that we're using that work really well together that are able to make adjustments and changes within their own lanes to be able to, you know, not have to just ride that roller coaster all the way from the top to the bottom. So with that, I think I don't think there's any other questions. I appreciate Joe, Brian. Thanks for your time here today. To those of you that joined the call, thanks for tuning in. We will be, this is recorded, so we will have this kind of package both as a full content as well as some smaller content to be able to get out to you. And with that, hope everyone has a great 4th of July. And as always, go Bills.
Go Bills.
Bye, guys.
Bye, everyone.
Thank
Thank
you.
you.